Welcome to the series where we explain and treat the consolidated financial statements. So if you're preparing for the ICAN exams or ACCA or other professional accounting examinations, it is very important that you have a rock solid knowledge of how to prepare consolidated financial statements. Now we're going to be doing this in a series, and today I want us to talk about what are consolidated financial statements. So that is what we're going to look at today. What are consolidated financial statements? Before I answer that question, let me ask you a question. Why do companies like Dangote Group present the financial statements of several businesses as one? That is what we call consolidation. Now, consolidation simply refers to the combination or consolidation, if you want, the presentation of the financial statements of various companies of a parent and subsidiary as if they were a single entity, even though they are legally separate companies. So when you present the financial statements of a parent and its subsidiaries as one single entity, even though they are legally registered and exist as separate companies, but you present them as one single entity, then that is what we refer to as consolidation. What is the standard, the International Financial Reporting Standard that governs the preparation of consolidated financial statements? You know, everything we do in accounting is governed by a standard or by a gap. So now in IFRS, International Financial Reporting Standard, the standard that governs it is IFRS 10, Consolidated Financial Statements. So after this short class, I want you to go and read everything you can about IFRS 10, all the rules and regulations, the guide, the principles that you are to follow in preparing consolidated financial statements. So after this lecture, we're going to ask ourselves, when do we consolidate? But before that, let me show you an example, just a brief peek of how we consolidate so that you have a picture of why the financial statements or how the financial statements of various entities are presented as one single entity. Usually the financial statements are the statement of profit or loss and other comprehensive income, the statement of financial position, the statement of cash flows, the statement of changes in equities, and the notes to the account. Let me show you an example of the balance sheet, that's the statement of financial position. You have the P. Let's say P is for the parent company. So we'll say P Limited. And here we'll say subsidiary S Limited. Now, if we have this, let's say we're working in thousands. Here we're also working in thousands. Let's say assets. We'll say assets. Here, let's say 100. Or let's say 1,000, and here we say 500. And then we say liabilities. For this company, let's say 2,000, or let's say 200, and here let's say 100. Now, in consolidation, given the explanation I did, a layman will think that you just come and add 1,000 plus 500, you add 200 plus 100, and then you are done. That is not it. You are being trained to become a professional, and so you have to do some adjustments. There are some adjustments. Let's assume that P bought 80% of the ordinary shares of S. So we'll say P owns 80% of S, just to illustrate. Now, if P owns 80% of S, then we'll say P is the parent company and S is the subsidiary company, but we're going to explain that in our series. For now, what I just want us to understand is what are consolidated financial statements. That is the major thing I want us to take away from this video. What are consolidated financial statements? Now, if P owns 80% of S, and we have in the balance sheet of P, we have assets 1,000. This 1,000 includes the investment in S. This 80% of the shares of S is included as the asset that makes up this 1,000. Now, the rule according to IFRS 10 is that you do not show the investment in S. So what do? You only show the underlying assets acquired, and you also show the goodwill if there is a goodwill made from it. You do not show as the investment in S. It is not shown. So the three things I want us to know first is you eliminate investment in the subsidiary. You eliminate the investment in the subsidiary when preparing the consolidated financial statement. You do not put it as a line item that the parent company owns, invested in this. No, you eliminate that. The second thing you do, you add the assets and the liabilities, but you do not add the investment. You eliminate the investment. Okay? And then the next thing, the third most important thing you do, you recognize what we call NCI. That is the non-controlling interest. To understand non-controlling interest, NCI, remember that P owns 80% of S. So there is a 20% that is not owned by the parent company. Who owns this 20%? Irrespective of the number, whether there are 1,000 different shareholders, we collectively call them non-controlling interest. That is NCI. So we also recognize NCI. We recognize 20% of non-controlling interest to show that that NCI does not belong to the parent company. The next thing we're going to do after this class is to answer the question of when do we consolidate. So now we have known what consolidated financial statements mean. In the next class, we're going to know when to consolidate. Do you consolidate when you own 45%? It depends. I'm going to tell you in the next class. Some will say from 50 and above 50 and up. Sometimes you could own less than that and you also consolidate. I'm going to tell you in the next class. I urge you to subscribe to the Finance Simplifier, where we demystify all the difficult subjects. So in finance, in auditing, in taxation, in accounting, and we do all of this very clearly so that people can pass their professional exams with ease. And so people who are professionals can be up to date and on top of their game. Even users of accounts who are not accountants, they can benefit from financial literacy tips, investment tips, and all of these that we dish out. So my name is Echela Okore. I am the Finance Simplifier. So don't forget, this is a series. We're going to take the Consolidated Financial Statements class step by step from zero to pro. That is what we're doing. So even if you don't know anything about how to prepare the consolidated financial statements, I urge you to subscribe and to continue to follow so that we will teach you from zero to professional. So after this, the next class, we're going to tell you when do you consolidate. Now we have known what consolidated financial statements mean. We said consolidated financial statements is when you present the financial statements of a group as if they were a single entity. Even though they are legally separate entities, we present their financial statements as if they are a single entity. And we say, when doing this, what do? We eliminate the investment of the parent company in the subsidiary. We don't state it. We remove it. The only thing we remember to carry is the underlying assets and the goodwill. Also, we said, what do? You aggregate the assets and the liabilities. And lastly, what do we say? We say if there's non-controlling interest, we recognize non-controlling interest. And we say non-controlling interest is that part not owned. So if you buy 80% of S, there's 20% to make 100%. So that 20% belongs to some other outside parties. And that is what we call non-controlling interest, NCI. So don't forget, make sure you subscribe and make sure you're following. Also, if you want to show love, to support us, to make better videos and to continue to sustain this, don't forget there's a link. Our seller is where you can show love, you can support, and you can also buy some of our digital products. So don't forget to support us. The link is in the description. You can see it there and support the Finance Simplifier.